From Bloomberg's World Headquarters in New York and from right here in London, I'm Caroline Hyde.
I'm Joe Weisenthal. Romain Bostic is out this week.
And meanwhile, he misses a volatile ride today. Risk off was the tone of the day. S&P 500 crushing lower, but the small caps really fell, tugged down by one of the biggest players on there, GameStop.
The question is, what'd you miss?
Well, of course, today marking 1 year since the S&P 500 hit the bottom during the pandemic, Joe. We have learned a lot about every fabric of society during this crisis, from social disparities to wealth gaps to healthcare. And we've also watched as governments, as central banks supported the economy to keep it on its feet during the lockdowns. Today, we look at how the market digested all these factors, but also how retail investors rose to prominence during all this chaos. Joe, the focal point for lots of those retail voices was this name, GameStop. We're just out with earnings after the bell.
Yeah, exactly right. GameStop, the ultimate retail play, the ultimate meme stock. You know, we've been talking about GameStop for weeks, and finally we actually got an earnings report. And look at that. Market really likes it. Stock nearing 200. Of course, the company naming a new COO, Jenna Owens. Some of the numbers, you know, on the surface, not particularly great. Q4 comp sales only up 6.5% estimated, up 8%. EPS missed. But, of course, this is not so much an immediate quarter story and more about the longer term. And right now, look at that. It turned out it was a value play all along.
Well said. I mean, it isn't notable that we have these continuing executive changes over at the top when it comes to GameStop. You had, of course, a new COO being announced. We just had yesterday reported the chief customer officer stepping down. We had the CFO resign. You had hiring of an Amazon alumni, Matt Francis. A lot going on, but for me, the takeaway is e-commerce doing better.
Yeah, the company, I mean, it's a real company. Let's bring in, for reaction, Rod Alsman. He's the co-proprietor of GMEDD.com, a GameStop bull since 2017, one of the originals. All right, Rod, you're a very serious investor. You've had 30 seconds to digest this earnings, though, and give us your complete analysis. What's your main takeaway from the quarterly report?
Yeah, Joe, a lot of time to really dive in deep. Scrolling through the release, I think the big take, looking at the 2021 strategic initiatives, you see a lot of language around customer experience, customer care operation. So that, I think, goes in line with what we've been seeing with these executive hires, focusing on improving their technology capabilities and really bringing the business from being that legacy brick and mortar oriented business to more of a digitized customer centric operation in line with, I think, Ryan Cohen's vision.
Talk to us about e-commerce, and happy birthday, by the way, if that balloon is for your birthday, Rod.
Belatedly one day, thank you. Too.
Ah, well, happy birthday. Global e-commerce sales, it says in the small print, increased 191% for the fiscal year 2020, representing nearly 30% of total net sales. How does that fit into your long-term vision of how much we move away from bricks and mortar and move into really digital only?
Yeah, the comp number looks great, which comes off a very low base. And as you noted, the 30% number, I think, is a little inflated given all of the pre-order activity for the new consoles that was pushed through the e-commerce channel. And, of course, we had a lot of forced activity through the e-commerce channel given COVID closures during much of the first or second quarter in 2020. So longer term, we'll want to see that number grow. I think we saw them report just under 700 stores were closed in 2020. So would like to get more clarity from the company on how they see that de-densification, that continued store rationalization play out going forward. But it's certainly moving in the right direction.
So this Amazon veteran, Jenna Owens, is going to be the new COO. Beyond what we see in the numbers here, what does that tell you about the sort of the crew that's coming together to turn this company around?
Yeah, you know, Joe, they've been making a lot of hires of technology-oriented vets for the past couple months, ever since the agreement between Ryan and Co. and the company was reached in January 11th. So it tells me that the company's taking it seriously, and they believe that that's their future, if that's where they're making these hires. You know, again, I mentioned the focus on customer, and I think there's a story out this morning in Reuters that I wanted to kind of highlight that really shows me how important the customer is, that kind of obsession with the customer to Ryan, and I think the folks that he's bringing on board, that he and the company are bringing on board. There was a story that Reuters had where he had a customer who'd sent emails to the company, upset about order delay, and Ryan reached out within 12 hours of the email to the customer directly, got on the phone with him, let him know, what was going on. He's upset about what happened, refunded the customer's money in tandem with Kelly Durkin, the new customer service chief. So I think you can see that they're going to really be embodying that customer-centric ethos of Amazon, like what Chewy did, and you're just seeing it already starting to play out.
We're already seeing Wall Street bets reacting to GameStop's results. And, I mean, there feels that there's tongue-in-cheek, as always. It says GameStop earnings misses top and bottom lines, proceeds to moon as expected. Whatever the case, this is a company that doesn't always move off fundamentals. But, Rod, your perspective is always on just where the stock is trading, 195, whether the story being told in these earnings vindicates that price point.
It's difficult to say, Carolyn. I think we continue to have the supply chain issues. You know, revenue came in a bit light. EPS versus the street came in a bit light, and they're going to continue to, as I think everybody in the supply chain is experiencing, these chip shortages. They're going to impact console production. That's going to, and obviously with COVID, there's been delays in software development that's continued to get pushed out later and later into 21 and even into 22. So, you know, those things obviously impact the shorter term results. But I think that it's pretty clear there's a very euphoric, excited investor base that may also be customers. You know, we've talked about this idea that these folks are likely not investing purely for the future discounted cash flows. So it remains to be seen if they're going to be long-term investors who are on board for this reinvention of this company. But you know, the market had priced in a massive move. I think it was a 30+% move was priced in the options market, and right now with it being up 5% after hours, it's pretty ho-hum.
Rod, the one thing we haven't seen, which some analysts have expected, is capital raise or taking advantage of this surge in the share price. You've said in the past that perhaps the best reason not to take advantage of it is that they just don't need the cash, that they can execute this strategic turnaround without more capital. Does what you see today make you feel confident in that ultimately the reason they're not selling stock is they don't need to sell stock?
That's right, Joe. They don't need to. They have over $635 million in cash and restricted cash. They just paid off their short-term note that came due on the 15th of March. They paid down all of their asset-based revolver. You know, they have access to cash. If they can lay out a pathway, we haven't had an investor day in years. So that's something that I think investors like myself and others will probably reach out to IR and be inquiring about after, if we don't hear anything about it on the call today. But that is something that I think many of us are eagerly anticipating, is in addition to those 21 strategic initiatives, what does the path forward entail? And if there is a need to raise capital to invest in e-fulfillment capabilities, et cetera, that would be okay. But right now there's no need to raise cash if we don't have a plan.
Ron, how much do you read what the sell side analysts, the buy side analysts are putting out from, you know, the larger institutions, and whether or not you care in particular? There's not a single buy rating on this stock at the moment. They all worry about the fundamentals not vindicating the price point. But to that point of having it in investor days, do the CEOs, do the executives now need to sit down with sell side, buy side analysts and try and give them their vision a little bit more actively?
I think there's been an adversarial relationship between the sell side and the company for some time now. I know in my reading and research that I've determined there is a significant portion of some sell side analysts' books who were short in the past. So I can understand why the company may have been reluctant to engage too heavily with some of them. There was an analyst that had a $1.60 price target on the company just a few months ago, for example. I think he's raised it to $10 now. So I think that they could improve that relationship by having an analyst day to help the sell side and buy side appreciate the direction they're going. But clearly, that was a missed opportunity a few months back when my team at gmedd.com put out our research, where we had really dug into things to understand that there was, in fact, an opportunity to justify the price reaching triple digits and higher. So that does remain to be seen what the path forward is. And right now, there's a lot of uncertainty, no matter how you slice it, as evidenced by the nosebleed implied volatility around the stock's options right now.
Yeah, we thought it, could have moved 30%, currently up some 4% after hours. Rod Usman, great to have you. As always, gmedd.com co-proprietor. Great insights. Meanwhile, coming up, we talk Treasury Secretary Yellen and Powell making their first joint appearance before the House today. We have more on the highlights, well, maybe some of the lowlights. This is Bloomberg. So today we're focused on, well, the one-year anniversary since the S&P 500 hit its bottom during the pandemic. One thing that has become prominent of late, of course, for investors is, well, worries about inflation. And Fed Chair Jay Powell addressed these concerns at the House hearing this afternoon. Just take a listen.
Our best view is that the effect on inflation will be neither particularly large nor persistent. And part of that just is that we've been living in a world of strong disinflationary pressures around the world, really, for a quarter of a century. And we don't think that a one-time surge in spending leading to temporary price increases would disrupt that. However, we have the tools to deal with that.
Once again, saying we got the tools to deal with it, trying to downplay any sort of worries about inflation, Joe.
Yeah. Joining us with more, Bloomberg Economics senior U.S. economist Yelena Shulyatseva. Yelena, thank you so much for joining us. Obviously, we've been hearing a lot from Powell lately. It seems like a lot. Was there anything new or what stood out to you today from what we heard from him?
Well, I think we should just put it in the context, right? This testimony was about the early legislation and how much that benefited the recovery. So both Chair Powell and Secretary Yellen had to kind of like make an assessment of what happened and how that earlier fiscal support really boosted economic growth. And rightfully so, they really praised themselves on the actions. And I think, really the testimony highlighted how the rapid government response to the pandemic, both fiscal relief and a wide array of monetary policy actions, played a critical role in what we are seeing today. So that was not the case after the Great Recession. So in that sense, this time around, the response was really rapid, was really timely, and powerful enough so that we can see the economic recovery as powerful as it is right now, and we are expecting an even stronger economic growth. So in that sense, I think they just confirmed our expectations. But in terms of new information on what to expect on inflation or any other things, I did not really hear anything new.
Yelena, you talk about the powerful recovery, and we did see, at the moment, we're getting this drip feed of data that just doesn't look so pretty because of February, the weather once again hitting the likes of U.S. new home sales. But is that just something to, well, to quote a rather famed Fed chair, is it transitory?
I think so. I think February data is really tricky. It's kind of in between a strong January and what we expect to be an even stronger March data. So you mentioned housing, and yes, I think it was the decline in new home sales and existing home sales was at least partially a result of harsh weather. If you look at mortgage applications to purchase, for example, we anticipated a decline in home sales because mortgage applications actually dropped quite significantly during the week of that freeze in the south of the country. And since then, they recovered for 3 weeks in a row. So I expect March will be a much better and more informative in terms of what happens to the housing market. I don't think that the increase, the backup in rates we have seen so far will derail housing market this year. It will slow down, but affordability is still really high, and I think it's just not going to ruin the progress in the housing market. Not until we see mortgage rates in the vicinity of 4% at least. We are currently at 3.3% on a 30-year mortgage. I think we're going to see much better data in terms of personal consumption because of the stimulus checks that were distributed in March, and we will already see that in the data. So,
Yelena, great to have your voice on, as always, taking us through, well, the views being given in Congress today, and indeed the views being taken from the data. Yelena Shulyatseva, of course, senior U.S. economist for Bloomberg Economics. Looking ahead, we've got 1 year since, of course, that all-important S&P 500 bear market bottom. We break down the year that was through the charts. That's next. Stick with us. This is Bloomberg.
And of course, as you know by now, today marking the one-year anniversary of the S&P 500 bottoming out during the pandemic. Let's take a closer look at that recovery and the outlook for the months ahead. March 23rd marks 1 year since the market bottomed, and the outlook for the economy couldn't be more different than it was back then. U.S. stocks having more than recouped their crisis losses, labor market expected to improve dramatically in the coming year, and household balance sheets are, in aggregate, flush with cash. The U.S. already vaccinating people at a rapid clip, and further acceleration is expected in the weeks ahead. And economic data is looking up. The Federal Reserve Bank of Philadelphia's latest survey of factories showing conditions in the region jumping to its highest level since 1973, and other surveys of manufacturing conditions also showing strong improvement. Meanwhile, the labor market expected to see a hiring boom in the months ahead. Service industry, starting with bars and restaurants, already getting going, with almost 300,000 jobs added in February. And this is before the pandemic has been fully defeated. U.S. consumers expected to engage in revenge shopping as more of society reopens. Fed Chair Powell sounding more upbeat, thanks to the ongoing support from Congress.
Fiscal policy overall will have really helped us to avoid much of the scarring that we were very, very concerned about at the beginning. And I think that's just the size and the speed with which Congress has delivered. It's going to make a huge difference in people's lives, and it has already.
But perhaps what's most interesting is not just that people are more upbeat than they were this time last year, but they're more upbeat in some cases than they were even pre-crisis.
50 million people spending $3 trillion plus a year in all these different forms are spending more money than they did last year and growing at 10%. And that was before the pandemic. That bodes well.
The massive infusion of cash to households, dramatically different than the response to the great financial crisis, and therefore could lead to a new economic trajectory.
Lessons of history. Nice beats on that package, too. Shout out to the producers. Meanwhile, Bloomberg Markets reporter Kriti Gupta is with us on market gains that we have seen. Some incredible eye-popping charts of just how far we've rallied. Split down first and foremost by asset class, because I feel like equities inched it, right?
It really did, and it was interesting because a lot of it isn't even just equities broadly, it's really just tech, and it's interesting to see that not only has that changed the U.S. benchmark, but it's actually helped the U.S. benchmarks become such a bigger part of the global equity kind of market cap. And I think that's a really interesting commentary because you're seeing that have very lasting effects. I mean, you can see on your chart right there, you can see this have very lasting effects because, I mean, we just heard from GameStop putting in massive emphasis on e-commerce, and I was joking with a friend of mine that e-commerce is the new reinstating guidance that really it was the thing that used to just make stocks rally, and now it seems to be e-commerce. So that really tells you that that kind of 2020 tech gains, once again, it is a long-term structural change that we're in for.
Long-term structural change in the meantime, and really over the last just several days, some of these like really intense trades are cooling off just a little bit. Some of these tech trades starting to fade. Are people talking about this as a moment where maybe like some of these long trends are like finally starting to take a pause?
I love that you mentioned that because you can see it from oil, you can see it from small caps, you can see it from things like airlines, for example, which are one of the most volatile stocks in the S&P 500. And part of it is a cooling off period, I think, even though we're pinning it to narratives like the European kind of demand crisis and vaccination race. And of course, that is a factor of it. But there's also this idea that it's rallied so far, why not pull back? And that's an argument that we used to see with tech as well. We used to make this argument that perhaps tech is selling off or having these corrections, not because they're losing steam or because they're no longer valuable, but because simply they rallied too far.
Rallying too far. Talk about that rallying too far. I mean, 50 trillion is the number that kept sticking with me globally, worldwide. That is such a phenomenal number because it wasn't just the US market that did so well.
Absolutely. And what's interesting is that it actually came out of China as well. And of course, this makes sense. This was really, you saw the Chinese market really rally. And of course, this matches their kind of underlying economic change. But Chinese tech is something to keep in mind as well, because that's really what kind of pushed these rallies ahead. It was names like Alibaba, for example, or Baidu, things that actually rallied even with that retail frenzy that you saw in Chinese markets. And now we're just starting to get a taste of just how much retail traders can move the market here in the States. And I think really China is such a great kind of path, or such a great kind of leader in that they have dealt with this volatility. They know what to expect. So I think in terms of where the future is and what leads and what type of participants you see in the market, China's a great example.
So what are you going to be watching next year? It is like the one-year anniversary, so March 23rd, 2022. What are going to be the themes that you watch to see now that we have sort of more, obviously well more than rallied back or at these nosebleed highs? What's next?
I think the big one is going to be those inflation, the things have to do with inflation. So I'm looking at, I think, semiconductors, which is kind of a weird take on inflation, but also a kind of a way to play the tech space as well. But also you have to look at things like energy stocks, for example, because I think they've become such a global proxy for kind of growth and economic growth out of China, economic growth out of the U.S., and yet their kind of prices are controlled by OPEC, by the U.S. shale producers. So there's a lot of push and pull there, and I think for me in the next year, it really tells you what era are we in? Are we in this era where oil is still a really big part of our lives, or is that kind of era of tech really taking hold?
Pretty Gupta. Good way to leave it when we had such a sell-off in the day with oil markets. We thank you. Catch her on the MLive blog. She always has really great takes. Meanwhile, Joe, I mean, you just asked Kriti what she's looking at for the next year. I mean, what are you looking at in the next couple of hours? What are you looking at overnight at that 4 a.m., check on the phone? Yeah,
I'm looking at the prices of the NBA Top Shop digital trading cards, which, like everything else, have actually been coming off from what I've been following over the last, week or so. So that's sort of that's the classic leading indicator of a downturn, what online trading cards are doing, and I'll see if that continues overnight.
Okay, all about those non-fungible tokens and keeping up to speed with, well, as everyone else jumps on the bandwagon. That does it from What You Missed right here, right now, though.
Bloomberg Technology is up next. Have a great evening. This is Bloomberg.